Some traders use one EMA, some use two. But what happens when the entire chart is layered with them, forming a structure that moves with price itself? That's where the EMA ribbon comes in, a strategy designed to visualize momentum, structure, and trend strength all at once. Instead of relying on a single line, the ribbon uses multiple EMAs stacked together, creating a flowing band that reacts to shifts in market pressure. But the real question is, does the EMA ribbon actually give traders a real edge in the market, or is it simply a visually appealing tool that only seems accurate after the move has already played out? In Volume 1, we rode momentum using the 9 and 21 EMA, learning how trends begin and how traders can stay inside them. In Volume 2, we pushed into speed with the 5 and 13 EMA, a scalping model designed to capture rapid bursts of market momentum. Volume 3 shifted the focus toward structure, using the 50 EMA as dynamic support and resistance to identify pullback opportunities inside trending markets. Then in Volume 4, the 200 EMA gave us something different, direction, helping traders align themselves with the dominant trend instead of fighting against it. But Volume 5 is different. This one isn't about relying on a single moving average to guide decisions. Instead, it's about multiple EMAs working together as a system, forming a structure that reveals the strength, health, and pressure of a trend in real time. Today, we're putting it to the test. To set up the EMA ribbon, open your chart and go to the indicator section. Search for EMA ribbon here and add this one. Now you got 8 EMAs stacked in one indicator. A common ribbon setup includes the following lengths: 8, 13, 21, 50, 100, and 200. Each of these averages represents a slightly different layer of market momentum. Once they're added, assign them different shades of the same color family, so they visually form a ribbon across the chart. The goal is not to clutter your screen, but to create a smooth visual structure that shows how tightly or loosely price momentum is aligned. The ribbon essentially turns multiple indicators into one visual structure that reveals how healthy a trend really is. When the EMA ribbon is fully aligned upward, it signals strong bullish momentum and a healthy trend environment. In this setup, the shorter EMAs, 8, 13, and 21, should be positioned above the longer EMAs like 50, 100, and 200, creating a clear stack structure that flows upward. As momentum strengthens, the ribbon begins to expand, showing that buyers are pushing price away from the longer-term averages while maintaining control of the trend. Ideally, price should remain above the ribbon, confirming that the market is respecting this layered support zone. Instead of chasing aggressive breakouts, the strategy focuses on patience by waiting for pullbacks back into the ribbon area. When price retraces into this cluster of EMAs and forms a strong bullish rejection candle, such as a bullish engulfing candle or a clear close back above the faster EMAs, it signals that buyers are stepping back in and defending the trend. This rejection becomes the potential entry point for a long trade. The stop loss is typically placed below the ribbon or beneath the most recent swing low formed during the pullback, protecting the trade in case the trend weakens. For the take profit, traders often target the previous structure high or use a structured 1-to-2 risk-reward ratio, allowing the trade to capture continuation within the broader bullish trend. Now, similarly for shorts, when the EMA ribbon flips downward, the entire logic reverses and the focus shifts to bearish continuation. In this scenario, the shorter EMAs, 8, 13, and 21, move below the longer EMAs like 50, 100, and 200, creating a stacked downward structure that signals increasing selling pressure. As momentum builds, the ribbon begins expanding downward, showing that the bearish trend is gaining strength while price remains below the ribbon, confirming it as dynamic resistance. Similarly, traders wait for price to retrace back into the ribbon. If the pullback forms a bearish rejection candle and price closes back below the faster EMAs, it signals that sellers are defending the trend and the move may continue. This becomes the short entry point, with the stop loss placed above the nearest ribbon, while the take profit targets previous structure lows or follows a 1:2 risk-reward to capture continuation within the bearish trend. The EMA Ribbon Strategy works best on 15-minute and 1-hour charts, where trends develop clearly but still provide regular pullback opportunities. On very low time frames, the ribbon can compress too frequently due to noise, while higher time frames produce fewer setups. This makes the 15-minute chart especially popular among intraday traders who want a balance between trend clarity and trading opportunities. I backtested the EMA Ribbon Strategy on the 15-minute time frame during high-volume market sessions, following strict and consistent rules. Trades were only taken when the ribbon was clearly expanding. Entries were executed on pullbacks into the ribbon. A rejection candle was required for confirmation. The stop loss was placed beyond the ribbon, and targets were set using a 1:2 risk-reward ratio. Under these conditions, the strategy produced a 74% win rate, showing that the ribbon can be highly effective when the market is trending and momentum is aligned. The losses did not occur randomly. Most of them appeared during low volatility, ranging markets, with a ribbon compressed and price repeatedly cut through the EMAs, creating false signals. When trades were filtered to strong, trending conditions, the performance improved noticeably. The conclusion is simple. The EMA ribbon is not just a visual tool. It acts as a trend strength indicator. And when the ribbon expands and momentum is clear, the strategy can provide a consistent edge in the market.